Guys, we were just sitting out there waiting. Yeah. Like 5 times. Could you set that up? I gotta use
who knows how? Where are all our people?
It's 519. Just tell them.
No, I know that.
You want to send it to the group?
Yeah, to send it to the group. You know what? I'm gonna just put that.
Just put the number. I'll see when we send it. I'll forward the previous one.
Okay, so yeah, send out the previous one.
All right, good evening, everyone.
Hello.
We're gonna get started right now. All right. All right, we're gonna get started. Share screen. Okay. So tonight I'm gonna go over SSQ. What's that?
You want to just remind them that it's recorded?
Yeah, so I'm recording this one as well. So I'm going to go over lots of it. It's going to be fast because I have 1 hour. It took me an hour and a half to get here. I was planning to be here an hour earlier to set up, but so that's what I'm going to do tonight is go through why SSQ. We started talking about it last week. I got so excited. I thought I got to tell you guys all about it now. And I figured by the time, it might take us, a few weeks or a month or so before I'm done coming up here for this boot camp. So I want to make sure that we have a chance to go through this and not put it off for like a month or so. So who here knows what SSQ stands for? I don't know that. Would you be able to monitor the Zoom for me?
Yeah.
Irene's going to monitor the questions.
What does it mean? What was
Do you know what SSQ stands for?
Yeah. Does anyone know?
no?
I know there is
No problem.
to do with
Okay. So it's society something or other, Quebec something or other, but that's not important. What's more important is the products and the value they offer, but that's your homework assignment. Figure out what SSQ means, because when a client asks you, you're going to look at them like a deer in the headlights and you're going to go, oh, I don't know. And it's better to know the answer. So we're going to go here because I've literally got less than 1 minute per slide, so there can't be too much chatter as I go through, unless it's a question directed at what I'm actually covering, okay? So I want to make sure that it's going to at least be the valuable hour while I'm here. So we're going to talk about the company, history, the strength, all that stuff. I don't have to tell you what we're going to talk about. I'm just going to talk about that. Look at that. That was less than a minute on that slide. SSQ's big, okay? 1944 is when they started, okay? A lot of clients go, how long has this company been in business? Would you mind muting that, whoever's got that?
Oh, Irene, is it your sound?
Yeah, just turn your volume off your computer because I'm hearing myself.
mine is mute.
Over 2,200 employees, offices in 6 major Canadian cities. Our head office that we deal with is in Toronto, okay? Business volume, $3 billion, $11 billion in assets. I mean, they're huge, over 1 million insured. And AM Best rating gives them an A-. And I had one person actually comment. Of course, it was someone that didn't have a contract with SSQ. They go, oh, an A-. Well, and I'm like, listen, you know what? That's based on the financial strength of a company and the ability to pay claims. By the way, it's an A- based on the fact that they're not as big as Canada Life. That's the only difference between SSQ and Canada Life. Company are invested in SSQ. Okay, so this could be a slight up-to-date slide. By the way, right after number 6, I believe La Capitale is number 7. I'm pretty sure, but yeah. So they're these are all well-known companies. SSQ is not as well-known because they've done primarily. We're excited because at Exterior, we're taking them not only out of Quebec into Ontario, which is the natural progression because we're attached, but we're now the ones shoving them down in the western area in a major way, which is really exciting, and they're starting to open up some great opportunities for us corporately to be able to pay advisors more. You guys will hear this in the next month or so, but we're actually listing these guys as one of our 5 platinum carriers, where when you build an organization with the generational overrides, we're actually giving you an increase. Instead of it only being 24%, I say only, that's still pretty good. It's still amazing. We're going to go from 24 to 30% on our first generations when we start building a hierarchy. Second generations, we're actually going from 12% to 15%. And on third generations, we're going from 2 all the way up to 5%, 2.5 times bigger. So when you start building a massive hierarchy, these numbers make a big deal. And we've now just welcomed SSQ onto that platinum level. So financial stability. SSQ, I don't know what those numbers mean. I'm going to leave this slide on our back office. You can research that after. I mean, I know what they mean, but I don't have time to go through all this. But basically, their financial stability is right there. It's amongst the top. Provide extreme disability benefit. For those that are familiar with La Capitale, the extreme disability benefit is the same as La Capitale's loss of autonomy benefit. It'll provide 50% of the life insurance amount up to $250,000 max, no additional cost, and it's offered on all individual life insurance products, and it's unique to SSQ, well, and La Capitale, okay? And here's the 5. So extreme disability by definition means that the insured is affected by a medical condition that renders him or her in a state of total irrevocable disability at least 6 months, as a result of which the insured cannot perform activities of daily living without a reasonable expectancy of recovery as determined by a physician, okay? So what are those 4 out of the 6 that would have to happen? Bathing, dressing, toileting, bladder or bowel incontinence, transferring, the ability to move in and out of bed, chair, wheelchair, and so on, and feeding, okay? So it's nice to know that there is something built in for that, should that occur. Traditional term insurance, we're going to talk about first. La Capitale has 3 types of term insurance products, okay? And if there's questions there, Irene, just let me know, okay? Yeah. There's a lot of chatting. I just don't know if there are questions that they need.
No,
Probably you got Barry and Crystal on there. They'll be chatting all the time.
No.
And then
talking about the audio, I think they're better now.
And then, so here's the traditional term insurance. They've got a T10, a T20, and a T70. That's it. Okay. The banding, it's nice to know this stuff sometimes, right? The banding is where you get a discount when you buy in bulk. So they go from 100,000 band, $250,000 band, $500,000 band, and $1 million band. Okay. You can also get preferred underwriting if you're applying for $250,000 or more of coverage. Okay. I'm going to teach you about that preferred underwriting though. You never quote a client on preferred. Always undersell, over to deliver. If the client comes back healthier than expected, they automatically up the value for the client, and they have the choice to actually increase the coverage or lower their cost if they come back as a preferred rating, okay? The term product, the traditional term product they have, which is they have a term exchange program. So if I was ever to sell a client a 10-year term, typically the reason is, not always, but typically the reason is the client can't afford a longer term. Now, I know the right reason to buy a 10-year term is that you only have a temporary need, 10 years or less, that you need the coverage. Because otherwise, if you need coverage after 10 years, your rates hike up quite a bit at the renewal, okay? So on a 10-year term, if it's the reason they're purchasing 10-year term, if it's because that's all they can afford right now, because they just got out of college, they have a baby, mom's staying home with the child, or a mat leave, whatever. Well, now you can sell them a 10-year term, and in the first 5 years, they can actually exchange it for a 20-year term or a term 7-year as things kind of iron out and get a little bit more affordable for them as they're starting out and get things going, okay? I always tell people to never sacrifice on face amount. Sacrifice on the duration of the policy if you have to, but don't sacrifice on face amount, okay? By sacrificing on face amount, what do I mean? Well, I'm a 38-year-old non-smoker. If I was on a limited budget and I needed $1 million in coverage, but maybe I've only got like $50 a month to spend. Well, for $50 a month, I can purchase a 10-year term for that price. I happen to know this because I price myself all the time. I always buy lots of coverage. So I could buy $1 million in coverage for $50 a month, and that's probably what my family needs. If I'm your average Joe out there working your typical job, $1 million in coverage is pretty realistic these days, right? But if I go to a 20-year term, it's now going to cost me like $80, $85 a month. Well, that $80, $85 a month might not be as affordable for me, depending on my financial situation. So is it better for me to buy a 20-year term for only $500,000 so I can get down to the $50 range? Or should I still buy $1 million, but just buy a 10-year term? I'm telling you right now, always sell the higher face amount, because if you walk out that door and you only give them the $500,000 in order to get them in a longer term, if they die in the first few years and whatever, and their needs are still high for insurance, you've done them an injustice. My other theory on that is if you sell them the term exchange in the first 5 years, they can always exchange it for a longer term. Okay, which by the way, you get paid new commissions if you happen to entice them to do that down the road, which is good for them and it's good for you. Okay? Yes.
Jamie, when they exchange it, what age is it at? The age of original purchase, or is it the age at the age at the time?
I'm not too sure. I don't know the next.
I think we have talked about.
It's what age is it?
But it should be the age when they.
The age when they exchange it? I'm not too sure. Yeah, that's a great question. When they do come here to do the training, then ask. If anyone on the webinar knows the answer to that, because I know a lot of you are experienced with SSQ, then let us know. So now, again, here's the preferred risks. There's non-smoker 1, non-smoker 2, non-smoker 3, non-smoker 4, S1, and S2. So every time you quote a client, you're going to default to non-smoker 3 or smoker 2. Those are the default classifications. And by the way, when you go to click on non-smoker, it automatically will populate non-smoker 3. This is like a preferred, and this is a preferred plus.
But where does this mean different? Oh,
Because
so
it's preferred,
okay.
preferred plus.
Okay.
And this is like a standard smoker, and this is a preferred smoker.
Okay.
Okay? So this is like your average smoker, and this is like your smoker that runs marathons. Okay? This is your average non-smoker. This is your guy that has no health issues, no height, weight issues. And there's your Olympic athlete, is smoker 1. And I joke with clients about that if they're asking, I say, basically you have to be an Olympic athlete in order to qualify for these. But hey, you never know. Let's try. And then you put it in. But again, you're quoting them on non-smoker 3, smoker 2. If it comes back better, then you're the hero. Okay? Renewable and convertible. Extreme disability benefit included. Additional benefits that you can get on these products. A critical illness rider. $20,000 for the 3 most common illnesses: heart attack, stroke, cancer. Okay. By the way, those make up about 90% of all CI claims. Okay. And it's $20,000. But here's the cool part about it. Do you know why most advisors do not sell critical illness insurance?
They know that
They don't
it's
understand it.
difficult for a lot of clients to get it.
It's expensive. It's difficult to qualify. There's a lot of reasons, but one of the big ones is it's hard to qualify. And you don't want to have to go back to your client and say, yeah, sorry, you got rated 50% because your dad had a heart attack at age 60. What's that have to do with me? Genetics, But that's like, right. But that's the argument that you'll get that a lot of times with critical illness. Well, guess what? You can cover the 3 most common illnesses, the heart attack, stroke, cancer, for $20,000 in coverage, and it's only based on the life underwriting. So as long as they get approved for life insurance, they're guaranteed approved for critical illness. So that's cool, right? Also, the child rider, life insurance protection for the insured's dependent children up to age 25. They can put the child rider on the policy as long as the kid is 17 and under. 1 child rider covers all children. Okay, that's standard with most companies. Accidental death and dismemberment. Okay, you guys, I don't have to explain that, do I? If you die by accident, you can get an extra lump sum paid, right? And if you lose a finger or if you lose a leg, You get a certain percentage of that lump sum paid out. Waiver of premium, right? If you're not able to return to work right after a disability, they'll start paying for your premiums for you. And then benefit in case of fracture. Accidental fracture or severance, the following benefits are payable. Skull, spine, pelvis, femur, $5,000. Breastbone, all those other ones, windpipe, all that, $1,500. Any other bone not mentioned, $750, right? So if you're short dough, just go crack at work. grab a piece of metal or something. So no, don't do that. Don't do that. Okay.
So give people ideas.
Crazy things can happen. There's your commissions, 40, 50, 50. Okay, that's the FYC plus your bonus, obviously. So let's just say you're a sales manager, 100% bonus. That means you would just double that number. 100% of 40 is 40. So 40 plus 40 is 80. So you're making 80%, 100%, 100%, depending on your contract level. Okay. Also, the renewals are great on this product. Most companies will pay 5% for the first 5 years and then 2% every year after. These guys just pay a flat 3% for the life of the policy. It's actually better long term, right? So it's nice renewals on that. And then additional benefits if you add a waiver, premium, accidental death, child rider, or fracture. Pays a 50 FYC, right? So you're making 100% if you're at a sales manager level. 5% for the first 5 years, and then 2% every year after on those riders, right? So the riders pay a different renewal than the base fund. Does everyone know what renewals are? Who doesn't know what renewals are? Ma'am, do you know what renewals are?
Let me say no so you can explain.
So renewals, renewals are the amount of money that you're going to receive in the second year of the policy and each year thereafter. So if it's 5%, that's 5% of the premium. So if the premium is $1,000 a year, every year on renewal, you're getting another $50 check, okay? And every year after. That's how you build your block of businesses with your in-force insurance business and your assets under management on the investment side, okay? Term 10 index. This is the second term option. So before I go into this one, what were the features of the standard term that we just went through?
That you can, the exchange.
Exchangeability. That's it. That's the big difference right there. Exchangeability, because the rest of them have all the same bells and whistles. But exchangeability is the standard one. That's a good feature there, okay? The term 10 index, this is an awesome one. Remember I talked about that client that couldn't afford the right amount of coverage because they were tight financially? Well, what if my budget is $30? But for me to buy $1 million, it's going to cost me $50 a month. But my budget is $30. I just can't do it. Well, now I might have to go with $500,000 in coverage to get into the $30 range, right? Because, and the reason I'm saying not half, because it's not half the price when you get lower coverage, because now you're the lower band, right? You don't get as big a discount. The more you buy, the lower the cost per thousand, right? So now if I'm a 38-year-old male non-smoker and I want to purchase $1 million in coverage, and my advisor, Willie, says, Jamie, it's going to cost you $85 a month for this $1 million that you need. Oh, geez, well, I can't do that, Willie. That's just too much. Well, that's for a 20-year term, and your mortgage, you got 20 years left on it, you know, and your kids are young. You're probably going to want at least a 20-year term. That's not something you're comfortable with? No, Willie, I just can't do it. Don't push it on them, because guess what? They're going to lapse the policy in 2 months, and that's no good either. So then Willie goes, well, tell you what, Jamie, here's what we're going to do. I can start you off with a 10-year term, okay? But at any point in time over the next 5 years, okay, we can actually exchange that for a 20-year term, okay? Now, it's going to be a little bit more expensive, and actually, Mary, I think I'm answering your question. I think it is at attained age, not issue age. When you go to convert, it's at the higher age. Don't quote me on that, but I think I remember these words coming out of my mouth a year ago, but I'm not sure. So, Willie, so you might talk me into taking that $50 a month plan for a 10-year term for $1 million in coverage. But Willie, I'm really broke, okay? I mean, I got pop bottles and stuff. I'm taking them back, you know, stuff. I'm walking around like my grandpa used to do this. He used to walk around after the parties. He lived across the road from this arena, and he used to go out and with garbage bags and collect all this stuff. And it's not because he was tight financially. He was just cheap and just wanted to make some extra money. That's what I learned. That was one of my first jobs. I used to do dumpster diving back when you could get the returns on the bottles when I was like 10 years old. But anyway, I went there. That was always entrepreneurial, you know. So Willie, I'm returning beer bottles for money. Now, if I'm drinking beer, so I probably have the money anyway, but that's another story. But nonetheless, I'm returning my dad's beer bottles for money. So, Willie, you're now going to say, well, listen, Jamie, could you do $1 a day? Willie, don't insult me. Okay. So that's $30 a month. Well, now for $30 a month, I can get $500,000 of coverage, and I can choose this option where every year I bump my coverage up by 30% first year, 25 the second, 20 the third, and so on. That ends up doubling my coverage over the next 5 years. So now I've got the $1 million in coverage after 5 years. Now it's still only a 10-year term, but this is a great option again for people. Maybe it's a 20-year term that you're selling them, and then after the first 5 years, coverage goes up. Here's another question for you. When you sit down with a couple and they're living in a condo, okay, and they just got married, is there a good chance that they're going to pop out a few kids at some point, right?
Yeah.
I mean, depending on chemistry and whatnot, but eventually at some point, or biology, how's that work? I didn't do good in any of those classes. Right? What's that? What?
The birds and the bees.
Yeah, that's right. Birds. So logic would dictate that a lot of families, probably most married couples, not all, different complications, so on, but a lot of married couples end up having children. Is it safe to say that the minute they have a child, their need for insurance just shot through the roof?
Yeah.
Yeah.
Right? So then maybe you're sitting down with a young couple and they don't need $1 million today. They might only need $500,000. But this will guarantee their insurability over the next 5 years. They can actually double their coverage. So there's unique situations where this is a really good product. Okay. The other cool thing is you're only underwriting them at $500,000, even though eventually they're going to have $1 million. And the other note is every year they're going to get something sent to them in the mail saying, do you wish to increase your coverage? If the answer is no, they can't take it the year after. They have to keep taking it each year to get the next year. If they say no 1 year, then it just stays at the $500,000. Or they could say no after the 30% bump and then stop after that, okay?
Question.
Yes.
Is the 30% the amount or is it the premium?
Both.
Both.
The premium's going to bump by, actually, the premium's going to jump by a little less than 30% because 30% is the increase in the coverage, but that doesn't change their policy fee. So it's going to be slightly less than a 30% increase in price. But I know for a fact on this one, Mary, it is based on issue age of the policy. So even though I'm 5 years older, I'm 43 in the last year, I'm still getting another 10% of coverage on age 38.
That's good.
It's kind of cool, right? And then this, I'm not going to go through that. Now, Term Plus is the next one. This is the final option. So there's, what's standard term again? Exchangeable. What's
Something is index.
index term?
Well, you can bump up your coverage.
Bump up your
every
coverage
time.
over the first 5 years, okay? And then the last one is Term Plus. This is the third term option with SSQ. And don't worry, there's only 18 other providers that we can offer term insurance for, so don't be confused. That's why we have the Experior Sweet Spot little thing that helps you out there, right? Now, Term Plus, check it out. Why are clients choosing Term Plus? It's a flexible, comprehensive, and competitive solution tailored to meet the personal and business protection needs of your client. All-in-one solution offering life, disability, and CI, a great alternative to the bank's products, and it's highly competitive pricing. Available terms are 10, 15, 20, 25, 30, 35. There's level or decreasing to 50% of initial amount. Guys, do yourselves a favor. No, never sell the decreasing to 50%. It's only a few bucks cheaper a month, and then your client's coverage actually decreases. Now, ideally, the theory of decreasing responsibility would dictate that in 5 years from now or 10 years from now, you need less coverage than you do today if you're the average person with a couple of young kids and you're done having kids. Your need for insurance should decrease. How many of y'all know that's not the way that Canadians are living? The need for insurance is not reducing. Guys, don't sell that because guess what? If you have a big $500,000 of life insurance that you sold to mom and dad dies 5 years later and now it's only worth $400,000, they only remembered the 500. Why do they only get the check for 400? Right? Welcome to your first errors and omissions insurance claim. Unless you documented it real well, and they could still sue you, and then you're still out money for a lawyer. So guys, just don't sell it, in my opinion. For the few extra bucks, just sell level cost, okay? Level. Renewable every 5 years after the initial term. This is actually an advantage because on a 20-year term, at the end of 20 years, if it renews for another 20 years, your rate goes to $1 billion a month, okay? If it goes to a 5-year renewable, it only goes up to like $100,000 a month. No, it's not. You see what I'm saying? Like, it's just not going to be as expensive because they're only guaranteeing the rates for another 5 years, but it makes it much more affordable in case the client still needs coverage after their initial term duration. It's also convertible, built-in guaranteed insurability feature, 25% of initial amount, maximum of 100. That means if you sell 400,000 of coverage, you've got guaranteed insurability of 100,000, which means they can apply and take that extra 100,000 anytime they want. And then the extreme disability benefit is included in all their products, as we mentioned earlier. So if we take a male 45 non-smoker, if you give them the standard term 10, the premiums are $6,800 a year.
They're asking for you to slow down, you're rushing.
I can't, I have
We
1
have
hour.
to get it done. They can.
But I will send this I will put this presentation on our back office. But I'm sorry, guys, I only have an hour, so I do have to fly through it. So a term 10 is $6,800 annual premiums in years 11 to 20. This is for the 45-year-old non-smoker. If they were to take the term plus, it's $5,250 annual premiums, years 11 to 15. Annual savings of $1,590. That make sense?
Well, after the 10 years for the next 5?
Yeah, the next 5 years are going to be that much cheaper for the 5-year renewals. That's what it's saying. So you're saving annually, you're saving another $1,500 a month because it's or a year because it's only a 5-year renewable versus a 10-year renewable at the end of the term.
That's not really telling you what you're saving for the first 10 years.
No, it doesn't. It only tells you the first 5 years. I'm not sure what it is the next. Let's see. Next slide. No, it's not my
Did it say
presentation.
years 11 to 15, this is after the 10?
That's right. Yep.
So after the 10-year term is done, if they renew it, it's going to be that amount.
That's right, for the next 5 years. So it's saving them $1,590 a year for those next 5 years because they're going with the shorter term renewal. Okay, so it just makes it a little more affordable. To me, the term plus isn't the be-all end-all for that reason, but there is this. You've got the total disability rider, accident and sickness, no financial documents needed. It's not an income replacement benefit. What's that mean? Not an income replacement, accident, sickness, total disability rider. So if you become totally disabled, ask your client 3 questions. Do you owe money on a monthly basis? Do you have loans? Provide a monthly indemnity, $300 to $3,500 a month, 1.5% of the life amount. Now, some of this stuff, because of time, you're going to have to play around with their software, get familiar with it, print out illustrations. Did you guys wouldn't believe me if I told you this. Did you know I self-taught myself in the brokerage world? I did. I got recruited to an AGA that only knew 2 products, and I decided I wanted to learn all the products. And I just decided to teach myself. I didn't even know wholesalers would come and buy me lunch. I just sat there on my own on every single company's software until I figured it all out. Now, you might be wondering, why don't you know all about this now? That was a long time ago. Everything keeps changing. And I didn't have an SSQ contract back then. But that's how you're going to learn is get on our back office, download the software, start running quotes for everyone in your family and every different carrier and see what you would buy yourself, because whatever you would buy yourself is probably a good indication of what you ought to be selling your clients if they're in your same situation. And you play around with that, okay? And then how much do you work a week? So these are the only questions. Do you owe money on a loan? Check. Do you work more than 21 hours a week for at least 8 months a year? Check. And what do you do for a living? So there's non-insurable occupations, okay? So it depends what you do. If you're a professional rock climber, if that's a job, odds are you're not going to qualify for this deal, okay? So depending on the risk of your occupation. A stay-at-home spouse or a spouse on parental leave can also get up to $1,000, which is cool.
That's all the term plus, right?
That's the term plus, yeah.
Only $1,000.
Benefit periods, all they have is 2 to 5 year benefits, and it can be changed to an age 65 option. Evidence is required, and the benefit is up to age 65. I want to get to the good part. We're not there yet. Waiting periods, 90-day, 30-day, if it's that. Age 65 benefit, 90 days, non-retroactive. Line of credit vehicle lease, maximum of 120 payments. That's 10 years. That's good. Okay. I want to get to the good part.
Mhm.
I might be able to go to 8:15. I'm going to say 8 just to be safe. Total disability rider, assistance benefit, second medical opinion, medical referral, psychological assistance, legal assistance, claims, proof of loan required at time of claim. That's it. Guaranteed insurability benefit, increase proportional to life increase, exercise simultaneously.
It's a rider, so you can.
Yeah.
to increase it.
Age 55 or less, monthly indemnity 1.5 of life insurance, maximum 3,500. You can do a needs analysis there. We don't need to. I'm skipping that one. Start conversation about CI. So cancer is the leading cause of death in Canada, and it's responsible for 30% of all deaths according to the Canadian Cancer Society. I figured they'd know. So cancer accounts for 68% of payouts on CI policies, followed by heart attacks at 13%. Significant decrease in CI sales in the industry since 2012. That's strange. So it covers all this. Why is there the decrease? Why are we not talking about it? Well, we mentioned poor field underwriting is one reason. Because we need to know certain things. We need to know that if both parents had a heart attack by age 55, you're not getting critical illness unless it's a simplified issue product or a rider like on here, right? But we have lots of simplified issue products. Another reason is the premiums are too high. But are they? Throw a $20,000 rider. See for yourself. For an extra $94, I think it is a year. I think it's going to say it in this presentation. It's like $94 a year to add a 20,000 rider. Longer underwriting process. Well, not if it's just as a rider and it's only based on the life, right? Family history doesn't affect it unless it's like polycystic kidney disease or something like that. But typically the family history is not going to affect you here unless it was something that would affect life insurance. And very few diseases that your parents had will actually affect your ability to get life insurance. Or you just want to get them as a client right away. So they're just thinking about life insurance and you just want to get them as a client. You don't want to start talking about too much stuff. But how many of y'all have clients that you set up and then you didn't talk to them for a few years? We've all done that. We've all been guilty of that. Sometimes you got to strike while the iron's hot. While you're in there, sitting down with them, putting their plan together. Okay? So the 3 covered illnesses on this rider is cancer, heart attack, stroke. Pays $20,000. Offered on all life products. Issue age is 18 to 60. The end of coverage is at age 85. Levelized premiums. No family history and longer underwriting times. And the assistance benefit that we just talked about.
Question.
Yep.
Since the end of coverage is 85, if the person didn't claim, didn't get anything by the time they're age 85, do they give back the premium?
No. But there is policies that we can sell with Le Capital and SSQ that do have return of premium, but not the riders. These riders are just kind of basic bare bones coverage to get them something. Okay. So let's just look at a 35-year-old non-smoking male. 20,000 critical illness is $94 per year, guaranteed until age 85. That's pretty cheap. That's per year. Okay. 50 years of protection cost them $4,700. And by age 85, there's like a 100% chance he's going to have one of those things happen. No. But there's a big chance, right?
Big chance, yes.
Especially if you're drinking Willie, right? He's going to have he should cash in 3 times. No. I'm just kidding. I don't even know if you drink beer. But but 50 years of protection for $4,700, and there's a big chance you're going to cash in. That's not a bad deal. That's all right. Well, do you guys know why insurance companies can do stuff like that?
Because not everybody claims and not everybody renews.
It's because most people's policies will lapse before they ever
They
make a
don't
claim.
renew.
That's how they can do stuff like this. The people that keep paying are the ones that will get the benefit one day. Odds are, right? 25 cents a day. I can't afford it. Is that right? Most of you guys throw 25 cents away.
Make your own coffee then. Don't get it free.
Who here bends over for a quarter?
Pick it up.
Yeah? Anyone not bend over for a quarter?
I pick it up.
Okay. Who here bends over for a dime?
I pick
Don't
it
use that word. Just
Anyone bends over for a dime? Who bends over? I knew you'd go there. Of course. You guys, man. Listen, start. Let's get your mind out of the gutter. I wasn't even going there. Usually I would go there. I didn't even go there. So who here would pick up 5 cents on the ground?
yeah.
I was just checking. I don't see how you guys. So you guys would risk getting some contaminated disease off of a coin that's on the ground for 5 cents. I'm just kidding. I'm just joking.
It's shiny.
Okay, so you're probably wondering how. Well, underwritten is based on standard life insurance. Okay, check the box at time of application. If you need help on that, it's right there. Check the box. That's it. Only available when blah blah blah. I can't read it, but check the box. You check the box. Now you got critical illness. As long as they qualify for the standard life, there's no longer a difficult underwriting. What's that?
You can do it anyway, right? And then if you choose not to.
Yes.
later
Yep.
on,
I mean, it's very affordable, right? Very affordable for clients. FYC on the 10 and 15-year terms is 40. FYC on the 20 to 35 is 50. The disability CI rider is 40, and it pays 3% lifetime renewals, which is really good. Critical illness insurance. I like this one. So I like SSQ's
This
critical
is
illness.
standalone.
This is
This
now
is
standalone we're going to talk about, okay? Nope, it's not. Yeah, it is. No, it's both. Maybe. I don't know. Just follow them.
Oh my God.
Only 3 illnesses.
I'm just the messenger that's
Yeah,
just reading
it's
off the
standalone,
slides.
yeah.
Now, some of you are going, I could do what he does. Exactly. Go build a business. You can do exactly. That's point and click. Guess what? All these presentations, you get them off the website, you look like a genius. If you just follow it, see, I try and improvise, and that's when I start looking dumb, right? If I just focus and just, you guys all be like, wow, I'm so smart. Pictures like, I read you. So the base is 3 elements. There's the enhanced, which is 25. The child is 28. I like the child with this one. By the way, the best child one, just so you know, in the entire industry is Humanity's Children 360. 37 illnesses, which is unbelievable. But there's a reason I like this one. There's actually a free option for children. Free is good. Okay. Individual and multi-life. T10, T75, T100, ages 18 to 65. T20, 18 to 55. T100 or 20 pay. Oh, that's cool. Paid up in 20 years, right? The cap has one similar, right? Child, T75, T100, 20 pay, and 30 days to 17 years of age to qualify. The rate bands, you're looking at 100 and 25, 100 and quarter million. Additional benefit, 4 conditions, 10% up to 50,000. So there's additional benefits on 4 conditions that aren't considered one of the 25 or 28. You can actually get 10% of the face amount. One of them might be, well, I might actually say, but I know one is typically like a breast cancer that's non-life threatening. That's one where you might only get like the 10% payout. Okay. Assistance benefit, second medical opinion, medical referral, psychological assistance, and legal assistance. Okay. So refund of premiums, you asked? Yes. Return of premium on death on all their plans is available. Return of premium at expiry, 100% at age 75. Okay, so you get all your money back at age 75. And then my favorite is the return of premium on cancellation, which means you don't have to wait till the policy's over to get your money back at 75. You can get 100% of it back after 20 years or at age 55. Okay? T75, T100, and 20 pay. Children's endorsement covers 15 illnesses. The waiver premium and fractures on it. Okay, let's move on, see what else goes on.
What does it mean by children's endorsement?
I know, I was hoping it would tell me next time, but instead it's tell me how much you make.
Isn't that a free option?
Go on, tell it, I don't know what it is.
Free option.
This is so out of place. Here's your commissions. We don't know what this is, but there's what you make. This isn't my presentation. I do all the talk at the end. These guys are throwing it in there. Children, oh, you make 40% on the children's endorsement. There you go. I really don't know what that is, though, honestly. Oh my gosh, really? You're not even gonna tell us. Okay.
What? You're making 40%.
We'll
So
find out.
What is children endorsement with SSQ?
What is it?
trying to find it.
I'm gonna find this because I really love it. Why would they just say what it? Why don't they tell us what it is? So. Irene, you had to ask because everyone else would have just been like, "Oh, I just assume everyone else knows," and they wouldn't have asked. But you had to ask. So you put me on the spot.
Ask and let's go.
15 covered illnesses available with basic and advanced protections.
Okay, thank you. So the children endorsement is the name of the plan.
Plan.
So it's a plan that covers 15 illnesses for the children.
Now everybody.
Thank you,
knows.
sir. So it's not endorsing nothing, it's just the name of the plan. Right? Okay, so SSQ's whole life insurance offers clients the benefits of whole life for the cost of term. What?
Right.
How's that possible? For the cost of term. SSQ's whole life insurance offers clients the benefits of whole life for the cost of term life. I'm confused. All right, so we're not selling term insurance anymore?
Yeah, really.
Non-participating, now they don't have
Offers the
participating.
benefits.
The price
benefits.
paid for the two.
Not the price. the
Oh,
benefits.
okay, sorry, the benefits, thank you. So Anne Marie's here, and her brain is functioning right now. So the benefits that we just talked about on all the other term products also apply to the whole life products. Thank you for clearing that up, Anne Marie. I was about to send out an email to the whole sales force. We're only selling whole
Still
life.
doesn't make sense the way they.
I know, well, it's
Yeah.
French, right? So it's a little. Willie, can you translate this for us? You're French. So whole life 20, whole life 100, and term 100. Okay. Premiums guaranteed for life. Level premiums payable to age 100 or 20 pay. Everyone knows what I mean when I say 20 pay, right?
There's no data. I tried to do a quote yesterday and it said no data.
On SSQ?
On the T100 pay 20, it came up no data in the system.
Okay. Yeah, we'll have to talk to SSQ after about that. The 20 pay means that you are guaranteed after 20 years to never have to pay another dime for the policy.
Tied up.
Okay? That's guaranteed. The cash values begin in the 10th policy anniversary. Guys, I wouldn't be selling this product with the whole life cash values as a selling feature. You would typically go to a dividend producing product to do that. This does not pay dividends, but therefore this is also going to be much less expensive as well. There's reduced paid up protection starting in the 10th policy anniversary. What that means is after 10 years, if you decided to stop making premium payments, there's a guaranteed paid up amount for life, okay? And then there's the extreme disability benefit. You can also add the 20,000, the accidental death, child rider, all the same benefits that we just mentioned with the term. The whole life pays the same as the term, okay? 50 FYC, or same as the 20-year term anyway. 35-year-old male non-smoker, $250,000 life insurance death benefit is $1,800 a year for a T100. That's really cheap, actually. And the whole life would be $2,065 annually. The difference is only $217 a year or $19 a month. Personally, if you're sitting with a client, I think if they have a little bit of extra money, for an extra $19 a month to build in a cash value that can protect the policy in the later years as they get older, right? Because the protection is they can use premiums, they can use cash value to keep the policy alive, right? Whereas T100, pure protection, stop paying, you're done, right? So I think it's worth it to go to that one when the price is that close, okay? But again, if your clients, you have to fill them out and do what's best for them. Yeah. Okay, universal life. Simplicity, availability, and competitiveness. The universal lives that I've done my homework on, I have found SSQ to be the best. I have not seen anything like them, and I was blown away 2 weeks ago when I was in Calgary, and I shared a little bit last week, and that's what got me excited to share this with you guys today, the universal life part of this. They've got the YRT, issue ages 0 to 85. That's good. You buy that all the way up to 85 years of age. Level T100 is 0 to 80. Increasing or level, increasing only on the level. This means the death benefit increases, okay? Do you guys know what it means with increasing in level on a YRT? Who doesn't know? Ma'am? Do you know? Okay. So increasing on a YRT means this. I start off with $500,000. I'm overfunding the policy because if you're part of Xperia and you don't overfund the policy like crazy, you're going to be terminated because we're not letting people screw clients around here, okay? So you're not doing that. So you're going to overfund the policy like crazy. You won't be terminated first. You'll be reprimanded, and then you'll be shown how to do it properly. And then if you continue to just make sales just to make a commission, then we have to get rid of you, right? Because we're not going to have that. Like, do you guys understand that there were lawsuit upon lawsuit upon lawsuit because of the way that people sold these products incorrectly to market it, right? They were projecting 12, 13, 14, 18% returns because in the 90s when the markets were taking off, and then all of a sudden the policies all fell apart when the markets tanked. Can't do that. That's why I was saying go with 4% return internally on these, even though you know you might get them 5, 6, 7 maybe. Go with 4%. Be conservative when you're selling these products. Okay. Last thing you want is a client 20 years from now calling you up and saying, "Why did my premium just jump to $1,000 a month? You told me it was going to last me like this forever." Right? You got to be careful. But increasing, back to that. Increasing means this. Willie, I sell you a $500,000 policy. It's YRT, which is yearly renewable term. Okay. The best way to explain this, okay, is actually like this. I'm going to show you guys. Y'all never seen this before. I'm going to annotate this. Watch this. I'm going to go like this here. Draw. Get the draw. Now check it out. Holy talkity talk in there. Eh? Oh dear. Now I'm just making spots. Crap. Hold on, I want to try and. Oh no. Here we go. I'm just going to go to a blank document. That's what I'm trying to do. No, I can't do that. Yeah, I can. Okay, watch this. This is how Universal Life works, okay? This was the easiest way. I was explaining this. I was 21 years old and I already understood how Universal Life worked because the person explained it to me properly. Where's the thing? There we go. Ah, okay. No. Draw. Okay, here's how it works. Ready? That's level. That's a straight line. Okay. That's straight. Okay. So over here, we're going to put in cost. Oh, this is taking a while. Cost. Okay. Or your premium. No, forget I said that. Erase that. Here's how I'm going to explain it. I get so much pressure. You guys are all looking at me. Okay, watch this. This is right here. This is my premium. That's a straight line, okay? That's a straight line just like the other one. So this is my COI. Cost of insurance. Okay, good. Huh? That's your cost of insurance. But no, it's not. Shoot, I'm such an idiot. No. Okay, watch this. No, I want to do it right now. It's going to happen. Watch this. This is actually, oh my gosh. This is so hard. I know what I want to do. I just can't draw on this.
You want to draw on the board? You can draw on the one.
Oh, jeez. Okay, guys. Can someone hold this for me? All right, cool. Okay, check it out. Now, we're just gonna turn the projector off for a second. Okay. Now, can you all see this in here?
Indeed, somebody says they can rub out the pen. Thank you, we'll do. Don't worry about that.
Can they see the screen?
Yeah.
Okay. So check this out. So this is how it works. This is the best way that I found to explain it. This is your cost of insurance in a YRT. It starts off nice and low. okay? But you need to pay more in premium in order to keep it alive, and I'll explain. The idea is you're going to pay the premium for a set number of years or for the rest of your life, depending on how you structure the plan. You can structure it to only pay premiums for 5 years, 10 years, 30 years, whatever you want. You can design it the way you want. There's so much flexibility in it. That's why I love it. But the shorter the duration of premium payments, the more you have to overfund it so that the policy stays alive. Make sense? So your cost of insurance in a YRT goes like this. And eventually passes this line. And this is now age 90. At age 90, although the cost of insurance is higher, it now levelizes until death. Okay? This is one of the big advantages of the SSQ YRT. Because at age 90, the cost of insurance is significantly higher than your premium. You understand? Because your cost of insurance might only be $20 when you're starting out, and you're putting in $100. So you've got $80 a month the first year going into your cash value. Okay? Make sense? But guess what's happening to your cash value? Well, it's making money. So actually, it's continuing to climb over the years because you're making a good return on it, right? So the money should be growing. But once you hit this point, your premiums are $100. Your cost of insurance is $100. Now, no more money goes into the cash value, right? But your cash value continues to grow and grow. Or your savings. I should use the word savings for this, so you're not thinking whole life, okay? Now, once I've got this money in savings, so let's just say right here, I've now got $100,000 of savings. And I know these numbers are all off, right? Because obviously, but let's just say there's $100,000 of savings, and my policy was initially $500,000 of coverage. If I choose level, and I don't mean level cost of insurance, that's different. We're using wire, so this is where it gets confusing. There's YRT, which is yearly renewable term, and there's level, which is a T100, basically. Make sense? But what I'm talking about now is the death benefit. That's a different subject. Is it level or is it increasing? See, it gets confusing because there's two terms level being used in this example of YRT. There's level cost of insurance, but if I did a level cost of insurance, here's the problem. My cost would have started up here at $150. Why? Because they would have to guarantee the premium till I die. Whereas with here, what it allows to do is go with YRT, your cost of insurance is way down here because you're only buying 1 year of term. And then next year, another year. And next year, another year. Now, the schedules are guaranteed. It's not like, they're going to change their mind and go, I think we're going to charge more this year. It's always going to be guaranteed, okay? But here's my point. Once it gets to this point here, where you have $100,000 in your investment, if you die right here, if you chose the level death benefit, you still just get $100,000 because this cash value, this savings, becomes part and parcel of the death benefit. Okay? If you choose increasing, now you get the $100,000 plus the $500,000. Here is my recommendation. Unless you are overfunding the crap out of it, and you'll know because as soon as you click illustrate, it's going to go, boom, this policy will explode at year 53, right? Or it doesn't say that, but it will lapse, right? If you, based on certain rate of return that you input in there. Here's my suggestion. To build the best plan here, sell them the amount of coverage they need from the start and make it level, not increasing, because level means that the cost of insurance is going to be, it's going to take less to keep this policy alive forever, is the moral of the story, because it's just a level death benefit, okay? Now, back to this. We know based on the premiums, $20 is now $100 after 20 years of paying in. This is year 20. Okay? What happens when my premium in year 25 jumps up to $150 a month? But I'm still just paying $100. Y'all know what happens?
The other 50% is savings.
They take the 50 out of my savings to pay the difference. And then next month they do the same, and next month they do the same. What happens when my premium's $900 a month at age 85? They're pulling the $900 a month out of my savings to fund the policy. The point of this is, I look at it like this. You guys have all heard the expression buy term, invest the difference, right? Buy term, invest the difference is the idea of purchasing term life insurance, and invest the difference means if you were to buy a whole life, it would cost you $1,000 a year, but because you're buying term, it's only costing you $20 a year. That leaves you $80 extra to invest. That's the buy term, invest the difference. This is like buy term, invest the difference advanced, okay? Now, there are cases where buy term, invest the difference will actually beat this, but there's also cases where this beats buy term, invest the difference, depending on the client's age and how you structure it, okay? We did an example last week, if you guys remember, a 35-year-old male non-smoker. If you remember, I remember these numbers quite clearly. 35-year-old male non-smoker could buy a 30-year term for $87.50 a month, okay? And then we were using a total outlay of $250, which means the invest the difference part was $162.50. You guys remember this, okay? And do you remember we were using a 4.5% return in a balanced fund? We're being conservative. Do you remember the cash value was about $117,000 after the 30 years? But when we did it in the universal life, the cash value at a 4% rate of return was around $150,000 to the exact same coverage. It was a higher cash value at a lower return because we said, hey, the fees are a bit higher in the UL, so let's go with 4% instead of 4.5%, and it was still a higher cash value. But not only that, at the end of a 30-year term, what happens to that policy? You can renew it or you can convert it. But I bought the policy for $87.50 a month when I was 35 years old. Now I'm 65 years old. My cost of insurance is going to be around $800 a month. You understand? And do I have this $800 a month to spend on insurance? Probably not. But guess what? With the universal life, I have a choice. I can cash it out, and I'm still further ahead than I was on buy term invest the difference. Or if I still need the coverage and I have other savings and I've got a pension and so on, maybe I want the $500,000 in coverage. And we structured it based on a $250 a month premium. Did you know at a 4% return, that policy will last you until the day you die? It goes right to age 100 and then it cashes out at age 100. You're guaranteed to get that $500,000 out of there, assuming you're guaranteed assuming a 4% rate of return, because you can't guarantee the markets, right? So does that make sense? Okay. So now here's my fear with universal. This is why I've never been a fan of it until I started to understand it more. If you only paid $40 in premium down here, you cross that line a lot quicker. Less time for the money to build up. All of a sudden, you start doing this and this and this, and guess what? Eventually, you hit a point where your money's gone. There's no more cash savings in there. The money's gone. You used it all to fund the premiums because you didn't overfund the policy properly. And this is not rocket science. Play with the software. You have to do this properly, okay? Does that make sense? Okay. So that's my quick lesson in universal life. Everyone confused? Does that make sense? That's okay. Well, no. I'm suggesting to know your client. See, level is fabulous if they have a boatload of money to put towards a permanent plan. You could sell them a level UL. There's a guarantee that no matter what, as long as they make that minimum premium payment, guaranteed they're going to get all the insurance value out of that. And then you can overfund it, right? There's going to be certain maximums that you have where the money can grow tax deferred, right? So there's advantages there. But I'm not going to suggest that to your typical client. I'm going to suggest that product to a client that's already maxed out on their RSPs. They've already maxed out on their TFSAs. Why would I overfund a T100, basically is what you're doing. Why would I overfund that when it operates as an RSP in this sort of way without the tax refund along the way? I'm better off to max out my RSPs because, yeah, it's tax deferred, but I also get a tax break right now. When you overfund a UL policy, you're not getting any sort of tax break on that overfunding. It's just being tax deferred, right? So my thought is that the level cost of insurance YRT makes sense for your high net worth client or your client that's maxing out RSPs, maxing out TFSAs, Now you got another cool way to shelter some money and some earnings and put it off for future years, okay? The YRT makes a lot of sense though, in my opinion, because of the fact that we can beat buy term invested difference with it. You can't beat buy term invested difference with the level of cost. I mean, that's, you just can't. You can get guarantees though, which is fabulous, okay? All right, back on track. Yeah, I'm just waiting for this now. Okay. Now, how do I get rid of this now? So now level, YRT to level at age 90, as I mentioned, that allows it to not explode in the older years. Like if it keeps going up to age 99, it can blow up and then all of a sudden you got 1 year left to make premium and you can't make the payments because the price is $5,000 a month because you're 99 years old, right? So that allows that. The level T100, as we mentioned, they're saying best in class. I don't know what that means, maybe in terms of pricing, okay? $5 a month policy fee, that's really cheap. YRT has a 7-year surrender charge, but it's a declining surrender charge similar to a DSC on a seg fund. It's fabulous, right? You're not paying these. I remember years ago picking up policies, they had a 100% surrender charge for the first 10 years. Absolute garbage. These ones don't have that. And then the level T100 don't have any surrender charges. Insurance amount adjustment options, no increase, and decrease, maximizer. There's all different things that you can do with these. As an example, I could decide I want to pay $100 a month for the first 5 years and then bump my payments up to $200 a month for the next 5 years and then bump it up to $300 a month for the next 10 years. You can play around with this all you want. You could actually go $200 a month for the first 10 years and then $0 after that, right? So you can play around and just make it work. Just make sure you're using projections. Like I said, I'm comfortable with 4%. Don't go anything above that, in my opinion, and make sure the policy survives at 4%. If the policy survives at 4% and you happen to make the client 6, good on you, right? You did a better thing for them. But at least you're not giving them this false hope that, hey, 20 years you're done paying, and then 40 years later they have to start paying again, right? You don't want to do that. This is what I love about this. They actually have the MERs on the funds are guaranteed, and they're 2.75% up to 3.25%, which is like a seg fund MER typically, right? LeCap's got lower MERs because they model after mutual fund MERs, but 2.75 to 3.25 is not terrible, right? That's a seg fund. That's a Canada Life seg fund, right? MER. So it's not this whatever that big word is I was trying to use. Outlandish, is that it? Outlandish?
Yeah.
There you go. So how do you say that in French, Will?
I don't know.
So there's not these ridiculously high fees. But the other cool thing is, get this, after the 5th year, in year 6, you get a 1% bonus, which means essentially your MERs just went to 1.75 to 2.25. Now you're in there with any mutual fund MER. That's fabulous in my opinion. I think that's just great. Includes benefits. Included benefits. There's guaranteed insurability on a child. So if you're selling a child this policy, it's a great option. Guaranteed, and a critical illness benefit for free built into the child policy. Mm-hmm. Privilege in case of disability and extreme disability benefit all built into those products. Additional benefits, you can add term riders to this, right? You can add critical illness riders to this. You can add child riders to this, the waiver premium, the accidental death, all the same benefits. You can totally customize an entire plan for a client around this product. The FYC, very, very competitive. We did the example with the term insurance, okay? If you sold the term insurance with LeCap, which pays the best FYC in the market, it was 55 FYC. Remember, we did it based on a sales manager. That $87 a month premium, you would make a little over $800, right? And then you'd make a little bit residual on the investment portion, the $162 investment. If you did it in the YRT product, which actually served the client better, as long as they had the liquid cash, okay, because we talked about that as well. They have to have the liquid cash to do it. The commissions were $3,200 to do a better job for the client, where you're making $800 in one case, you're making $3,200 in another case, right? It's absolutely fabulous. But just to see the numbers, it's 65 FYC on the target premium. The target premium, in my opinion, is your minimum premium. Don't listen to them. When they say minimum premium, that's not the minimum premium. The minimum premium is the target premium. And then check it out at 4% and make sure it flies, okay? Advisor tools available. LifeSuite gives you in real time the status of policies pending, access status to all underwriting steps of your new contracts. Ingenium, access all contact information for your clients, provides access to all your contracts, commission statements. I don't think that applies on you guys because ours is all done on our back office, but I could be wrong. Now we're at version 9.0. I think they're sending out. I just got a memo, so you'll be getting that. But you can download all the updated software right off of our back office. It's available there. You need the first piece of business to sell a policy. Okay, you need the first, obviously, you need the first piece of business to submit a contract to head office. Okay, so we don't want contracting coming in without a first piece of business with it. There's paper apps, and you can also do electronic applications, but they're not real electronic. It's more like a PDF filler, and then you still have a page that you need to get the client to sign a physical page. If you do it that way, though, we can accept scanned and emailed copies. But if you're using the actual paper application, which I'm still a paper guy, so I would do that, but we need the originals for the paper applications, okay? So again, today's takeaways, SSQ has the unique extreme disability benefit only available through the Capital or SSQ. They've got the Term Plus, a multi-purpose life insurance solution, all different types of riders and features. Increase your sales with the critical illness rider. Why whole life is the new term life? I don't know why that. I still didn't get that question answered, but it's okay. And then the best in class universal life, and we also have the level T100. There's the wholesalers there. So we're going to schedule probably in the next month or so. I'd love to have them come up here and do a more kind of in-depth training, possibly take you through the software and stuff like that. I think that's it. Position to serve you better. I think that the underwriting, I've been having some success with it. I don't think it's that brutal, right? I think it's pretty good. Some carriers are slower than others. These guys are kind of middle of the road. You're not going to beat your Assumption. You're not going to beat your Humania, with these guys. Those companies are exceptions on how fast they're issuing policies, right? But if the client needs a universal life product or a great term option, and maybe Le Capital is not a good fit because Le Cap and Humania have great term options as well, then obviously that these are a platinum provider. And do you guys remember did I even tell you guys who our platinum providers are? Yeah. I did? Right? Le Capital, SSQ, not Assumption, they're gold, but CPP. So Le Capital, SSQ, CPP, Humania, and Faith Life. Yes, thank you. Yeah, that's right. So, and by the way, our bonus isn't even as high with Faith as it is with Assumption as a corporation. But the reason why we put Faith Life on the platinum is because we wanted to make sure that that's a company we're focusing on. Because Assumption is a great company. I love Assumption, but we needed a par product on our main shelf as platinum provider that was outstanding. And the Assumption Life par product is mediocre at best. It's not a competitive par product. Now, they've got some other competitive products like every company does, but we were missing a par product on the shelf of our main 5, so we decided Faith Life's the way to go. They have a better par product than Equitable even, which speaks volumes because Equitable's got a great par product as well. And just so you guys know, we're still working on that contract. Don't hold my feet to the fire on this one, but we will probably know on Thursday when we come to our office in the afternoon. So I'm very hopeful, but we'll see. Okay. So any other questions, guys, tonight? Is that too soon for you guys? Should I went slower?
I have one question.
Yes, one question by Dick.
In regards to universal life. So
Yeah.
Say so, because when I was I recommended corporate insurance to a couple of clients, but I always went with the Canada, what's it called, participating policy, because
The Canada Protection Plan, you mean?
Canada Life. When I
Oh,
was
a
at
participating.
investment
Right,
So
participating.
because I didn't have to pick the investments.
Mhm.
So, like, if you have that situation, would you recommend UL versus?
So here's where UL is better. Okay, UL is better if the markets are doing okay.
Yeah.
Whole life is better if the markets are doing garbage, right? the world's going to keep going, right? The sun's going to come up tomorrow and it's going to go down tomorrow night and then it's going to come up the next day. I personally believe that things are going to be about like they've always been, okay? The markets have done somewhere between 10 and 14% over the last 60, 70 years, and they continue to do that. Now, that's obviously gross, right? Because then you've got the fees and management and stuff like that. But, you know, the markets are doing what they've always done, right? What's happened in the last 20 years, oh, this bad crash here, this here, that here. Well, y'all remember the Great Depression? Well, I don't know, not all, right? Maybe some of you remember it, but I didn't remember it, right? I wasn't here. But you know what I'm saying? Like, there's always a bull and a bear market.
Yeah.
By the way, quick lesson. Do you guys know what a bull market and bear market means? Do you know why they come up with those terms?
No.
No? See, I didn't know for years. A bull market, because the bull is like charging you and it's powering up, and the bear is the claw coming down. Boom. So the bear market is down and the bull is up. I don't know if you knew that.
I know.
And now you know. And it took me, I was years in the business before I knew that. That's where the terms come from. So, you know, there's always going to be bull markets and bear markets. This is how it is. There's a lot of argument that if your client is extremely conservative and they have a permanent need for insurance, sell whole life. If your client is willing to take more risk and they're more aggressive, sell universal life. If your client is somewhere in the middle, explain both. Okay, like that's kind of the rule of thumb. If the client has these permanent needs. Now, if you're dealing with middle class Bill and Bob, Bill and Sue, whoever, and they need a family plan and they're living paycheck to paycheck like 90% of Canadians are, what are you going to sell them? Term insurance, right? Now, you're going to do your best to maybe put a permanent base plan with a big bunch of term rider. You try and do that if you can, but we can't nickel and dime clients to death. We have to give them the best value. But I always suggest, offer them, say, hey, if you guys want for an extra $20 a month, I can give you guys a guaranteed 25,000 T100 permanent whatever for an extra $20 a month. Would you guys be interested in that? A lot of times they're going to say no if they're on a tight budget, but you never know. Sometimes they go, yeah, you know what? I'd really like to know that something's there long-term for us, okay? So again, conservative clients that have a permanent need, what is typically their best solution? Whole life. And what about clients that are a little more aggressive, permanent need? What's their solution? Universal. Yeah. And by the way, not necessarily. That's a good rule of thumb for maybe 50% of the time that you could figure it out that way. But then we also have the human element, right? I personally, I see the value of SSQ and I see the value of selling that to a child and you know, having it where you pay for 20 years and stop paying and you overfund it and it's going to last forever. But I also like Faith Life's product even better, even though you might not see as big in numbers as if you were to do this. But the Faith Life one, it's like come hell or high water, that thing is guaranteed. Now, the dividends aren't guaranteed, but there is a base portion in there that's guaranteed. I'm also guaranteed to never pay another premium after 20 years. To me, you're dealing with the kids and the family like that, I would sell the Faith Life 20 pay life over the Universal Life 9 times out of 10. That's just my viewpoint on it. I have a group of advisors in Calgary that are doing a fantastic job. They've really clung on to SSQ. They really like them. And they would, you know, they probably 10% of the time might look at Faith Life and 90% of the time we're looking at this, right? So everyone has their different styles. My suggestion is learn everything. Don't just be, you know, focused on just one thing for everyone. There is no one size fits all in this industry. It's every client has different needs. If I went around this room right now, actually with a show of hands, just in this room right now, who here thinks if you were to spend $100 a month today on insurance to buy something for estate planning purposes, just an extra $100 a month for estate planning purposes, whether that's $100,000 if you're younger or whether that's, you know, only $10,000 coverage if you're older, who in this room would choose the Universal Life YRT as their option for that extra $100 a month estate planning? Show of hands. One? Okay. Who in this room would use a participating whole life as an option for their estate planning? That's hilarious. Wow. So most of us in this room. So, and you know what? By the way, a lot of that would have to do with the way that we were probably brought up, many people in this business. Again, we have a great group in Calgary. They were brought up in a group where it was mostly Universal Life, and they got familiar with that and comfortable with that. So, and if, by the way, if I sat in a room full of my teammates that I used to work with, where I spent 10 years of my life and all they sold was term insurance, they would have said anyone that just put up their hand was blind and didn't understand the industry because they only sold term insurance, right? So, you know, there's more than one way to do this business, and that's interesting. I'm very interested by that response. Yeah. So again, know that this product's there. It's a great tool for your clients. All of these products are great tools for the clients. But I am probably, like you guys, most of you has answered that you would probably lean towards the power whole life type thing. I'm kind of that way too, because I like that there's some guarantees in it. You know, and I think that's where you guys are probably in the same boat. So anyway, that's awesome, guys. Thank you so much for the time. And I got to fly out of here, but thank you. Appreciate it.
Thanks,
Thanks, guys, for tuning in on the webinar land there. Hope you guys learned stuff. See you guys.
See you all next week.
We got a lot on here. Wow. Clear as mud, eh, Tony? I know it's a lot, eh? That's funny. Was there 30? Oh, that was 37 questions. I was like, was there 37? Yeah, 12 on there. Hey, John's on there. Tremaine, Tony, Suzanne, Sahenwa, Irene, Faith, Denwai, Crystal, Barry. Good to see you guys. Thanks for tuning in. Appreciate it.
I tried.
Yes.